dot, and it shows. Oh, come on. Did last time. No, I don't want to. A new one. Ah, I got something.
Can we get 3 hours for the final or 5?
Oh, you can have a
Okay.
it's writing. Look at that. Isn't that weird? Now it's doing that.
Is it not supposed to write?
Now it's pointing. Well, yeah, except I guess I just use big letters. I use big letters today. That's working. Okay, trust it.
How do you make your little thickness thingy?
It's gone. That. 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 It's right. Right. How you doing? We'll work. Okay. So you got a problem you want to do?
Can we do a bank reconciliation problem?
That'd be a good idea. Let's see what we want to do.
There's one. It's like petty cash bank recon. Like it's gonna be like petty cash recon.
You want to do one of these petty cash and a bank reconciliation?
Yeah.
Like 7.
Like 712, yeah.
Did I sign that one?
I don't know if you did.
Okay.
Problem or exercise?
Problem 712.
Problems.
Okay. Bill Joby is reviewing the cash accounting for Nodelman Inc. Did I sign on? You guys are supposed to work them all. Here's the suggestion. I had 1 through 4, 7 through 10. Well,
Okay.
but that's all right. It's more of the same anyway. Right? There were some exercises in the bank reconciliation. Maybe we'll do an exercise because they're shorter.
Okay. So what?
That one might take a while. We can do a petty cash one, and if you want, and then we could do a bank reconciliation one too, like 725, for instance. Maybe do that, or 724 or something. So why don't we start with the petty cash one? Let's do 722 on page 393. It says Carolyn Keene Inc. decided to establish a petty cash fund to help ensure internal control over its small cash expenditures. Okay. The following information is available. They established a petty cash fund for $200. Then there's a summary of all the expenditures, and then it was replenished, which means they cash, right? Brought it back from 27 up to 200. See that? And then the petty cash fund balance was increased from 100 to 300 April 20th. It'd like the journal. Okay, so what would you do with the first one here? This, and I'd probably start with this next one. Okay, April 1st. Exercise 722. April, what? What would you debit, of course?
Petty cash.
Petty cash. Or $200. And then you took it out of where? Checking account, right? So it'd just be cash, or cash checking, or whatever you called it, right? Cash checking or something. Or a particular bank or something like that. So you took it out of the bank, wrote a check into petty cash, and you went to cash the check, and you put it in the petty cash box, right? Okay, and then here's what happened as of April 10th, right? They had all this stuff go on. So what would you do on April 10th? You are going to replenish the account, right? Which means you're going to bring it back up from $27, which is in there now. You can't know what's out there, 27 bucks. You're going to bring it back up to 200. But remember, you did not ever reduce the cash account in the general ledger. It's an impressed balance, which means you just leave it the same. Okay? So what you would do is you'd write a check to petty cash to bring it back up, but you won't debit petty cash. It's already at 200. So I'm going to credit cash checking for how much? What do I need? 27 of 200, how much?
175.
That's it. And what do you want to debit? We didn't leave enough room, did it? Way to go, Keith. Oh, can't you undo? Write something you don't want to. Okay. And so, what do we want to do? I want to credit cash with the amount we took out. How much did you say it was?
173.
Okay. And then debit what? What you put it in? Delivery charges and merchandise purchase. What would that be? Trade in? Freight in or purchases, depending on what kind of inventory method you're using, or not purchases. Freight in or inventory, depending on what method you're using, right?
But you just call it just inventory.
You can just call it inventory if you're doing perpetual. It doesn't tell us what kind, so yeah, that'd be fine. Or freight in, right, if you're using periodic, it would be purchases plus freight in, right? Okay, anyway, supplies purchased and used, we use them up. What do you want to call them? Supplies what? Yeah, because you used them. Good. We hadn't used them yet. It would have been supplies inventory, right? Okay, postage expense. I bet we could call that postage expense. Okay. If it was stamps that we're going to use later, we'd probably debit off the supplies for that. IOUs from employees. Accounts receivable from employees. Okay, what an IOU is, of course. And then we have miscellaneous expense, right? That's all there is to this. Which hope I give you one of these. But they do that on the CPA exam, they do stuff like that. Now, I might, you never know. Anyway, does that journal entry add up? No.
There's $2 missing.
Oh, that's right, because when you add up all those,
It's just 171.
yeah, it's only 171. Oh, and there's 173 missing. What happened? 2 is missing. You can call it cash short if you want. Cash short. Sometimes it's over. If it's over, it might be cash short / over, right? For $2. It's an additional expense. I would just plug it into miscellaneous expense. It was me, right? Additional expenses. If you're doing it on the CPA exam or on my exam, put in cash short. That's what you do. Okay. Got it? Then it says the petty cash was increased from 100 to 300 on April 20th. So what do you want to do on April 20th? Increase it. Write a check to petty cash and put it in the petty cash fund, right? In the drawer. So when you credit cash checking again?
Yes.
This was cash checking too, of course, right? Okay. For 200, debit what? I don't want the petty cash to be 200. Oh, it went to 300, didn't it? Wait a minute, it didn't start at 100. Increased by 100 to 300. Is that what they said?
Yeah, it increased from 100 to 300.
One thing about this, I can have an eraser and a pen at the same time. Probably what the setting is supposed to do, huh? Very nice. Okay, and this would be what? Petty cash. Like it? Now, can you guys get that right if I do something like that? See why I didn't really spend much time on it. Can you work a problem like this and know what you're doing?
So like
Yes,
just
work problems. Huh?
Wait, why isn't that just 100 and not 200?
Oh, it
Because
was
it went from
increased 100 to 300. They already had 200, didn't they?
Oh.
And I read it wrong, too. They didn't increase it by 200, they increased it by 100.
Okay.
Okay, good deal? All right. Then maybe we'll do bank reconciliation and adjusting entry, 725 maybe. Okay, let's try that one. So what do we know here? So this is exercise 725. And it would be good, by the way, to work that problem. If you wanted to work it, have the two together, then you can look at the answers. But it'll take you longer. right, through most of the weekends. Logan Bruno Company has just received the August bank statement, which is summarized below. So that's everything that's on the bank statement, right? Beginning balance, what you got, the ending balance. If we're doing an August 31st reconciliation, what's the balance per bank? 8,089, right? You got it, don't we? See that there? Balance August 31st. The general ledger account shows this. We're going to have to calculate the balance here, aren't we? Did you take the 10,050 plus 35,000 less the 34,903? Can you guys do that? To find the ending balance? Yes?
Yes.
Okay, so what I'm going to do if I'm doing a bank reconciliation, if I'm going to do the bank reconciliation, I want to start with the balance per bank and the balance per books, right? And I want to reconcile between the two of them. Right, guys?
Yes.
So let's get our balance per bank, or per books even. What's the balance per bank? Easy. They gave it to you. How much is that? 8,089. Balance per books. How much is that? Well, you're going to have to compute it for me. Take the beginning balance of 10,050, rather. Add 35,000 receipts. We got 45,050, right?
Mm-hmm.
Subtract your 34,903, and what do you have?
10,147.
Okay. So big deal, they didn't give it to you. They could have calculated, but we don't care. All right. Then it says deposits and transfers, 3,800, checks outstanding are, and those are at the end of the month too. Thank you so much. Plus there's cash on hand at August 31st. So what if, or at August 31st at 310, what's that? Cash on hand is going to go in the cash account, but it doesn't go in bank reconciliation, right? Would you agree with that? We probably have an account named cash on hand. But when we do cash in the balance sheet, we'll include it, right? We'll also include the petty cash. You know, separate ones in your balance sheet, probably. But for our reconciliation, we don't need it, right? Because the bank doesn't even know about that or care about it. True? Okay. The bookkeeper improperly entered one check, got a transposition, which is an error. So we've got an error. And in real life, you have to go find those. But you know what? We have a computer routine that'll compare what cleared the bank to what you wrote the check for, declared the check at. Same with the deposits, what cleared the bank versus what you deposited. So it's kind of a surprise. It catches the point. All right. So tell me what you want to do. Where do the deposits in transit go? Are we adjusting the balance per bank or the balance per books? Who knows about those deposits? Do we know that we deposited it to the bank?
Yes.
Yes. Do we have it included in our bank balance, or our book balance per books? Yeah, we deposited it, we know about it. Does the bank know about it yet? No, it's in transit. So what would you do? Add the deposits in transit. Just coming back for principles. 3,800? I'd add the 3,800, wouldn't I? Right? Because the bank doesn't know yet. Is the bank wrong? Do they need to make a journal entry? Of course not. It's going to get there in a day or two, right? Okay, how about the outstanding checks? Do I know about the outstanding checks? Yes. I wrote them. I took it out of my bank balance, didn't I? My balance per books, I'm sorry. I took it out of there, right? It's already out. This number already has both of those out of it, don't they? Okay? So what I'm going to have to do is take it out of the bank balance. Not that they're wrong, they just don't know about them yet. They're still in transit, right? They're outstanding. Okay? So deduct outstanding checks. How much was that?
1050.
Got the idea? All right. What about that error? There was a check for $146.50, which would have cleared the bank at what? $146.50. If we looked at the bank statement, all the detail on it, wouldn't it be $146.50 coming out of the bank, seeing as that's what the check was really written for? Yes, but we recorded it to supplies expense for $164.50. What's the difference between those two? By the way, it's going to be divisible by 9 because it's a transposition, right? What's $164.50 less $146.50? 18 divisible by 9, isn't it? So if you're off when you're done doing the reconciliation, right, by amount, divide by 9 and see if it's a transposition. Also divide by 2 to see if you have a debit as a credit, right? Throws up the error. Both of those are handy. But anyway, so it's $18. We have too much supplies expense, don't we? So what I should do is add that back, right? Add error It is adding it, isn't it? I took too much out. I should add the 18 back. Debit cash, credit what? Looks like supplies expense to me, right? Good? Are we good? Sure. Come on, keep supplies. All right, $18. So I'm going to add that one back. Okay, good. By the way, am I in balance yet? Not even close, right? Well, I don't think I am. Okay, I'm going to keep working until these are all in balance. But first, let's get the stuff that we do know about. We know about that when they gave it to us. Usually, you wouldn't know that when you'd be off by $18 and have to go search for it. Does that make sense? Okay. All right. So then, when we look at the bank statement, that's the only thing we haven't done yet. What's on the bank statement that we might not know about yet? Do you think we know about the deposits? Of course. We recorded those and then we sent them to the bank. Do you think we know about the checks that are cleared? Yes, we wrote them all. Do we know about the note collections, including $40 interest? Probably not. Okay? So does the bank know about it? Sure, they put that in the bank account, didn't they? Shows are on the bank statement. So what we should do is add the note. It's note and interest, isn't it? It's payment. We received 1,040, including $40 interest. So 1,000 against the note, right? It's going to be debit cash for 1,000, credit notes receivable, and it's 40 for the interest, debit cash and credit interest revenue, isn't it? I know you guys know this. Okay, so I'm going to have to make a journal entry for that one too, of course, because that's on my books. Huh? And then what else do we have left? Bank service charge? Deductible, of course. If they took it out, the bank took it out, and I have not yet taken it out, right? Out of my account, probably. Okay, and that was 20. Let's see if it worked. What's your adjusted balance in both cases? Is it going to be the same? I hope it's the same. If not, we're not done yet. Beautiful weather, turns spring, everything turns green like it hates.
No, they're still not balanced.
They're not. Really? What do we do wrong? We put 808 times ending balance. Added to 1040. It is at 18. How much are we off by?
Wait, hold on.
What do you get for total?
I got 10,998 for the balance on per books. So we got
10,998. What you get for the other one? Doesn't look like it. Is it the same? That doesn't look like 998 though. 10,147 plus 18. It's a 5.
I got 10,839 for the first one.
Which one?
The bank. And for,
10,839.
yes.
And what'd you do in the books? That doesn't. That's got to be 15. It's got to be a 5.
Minus 20.
Uh-huh.
I got 11,185.
Okay, let's see what I did wrong here then.
You're off by 346.
346. So it's 11 something, you said, right?
Yes, 11,185 is what I got.
I want you to do another thing. Try again. Add 10,050 plus 35,000. It's 45,050, and then subtract 34,903 from it.
10,050, 35,000. Minus 34,903.
Huh?
10,147.
Oh, you know what? How much are we off by?
346.
346.
Yeah.
The bookkeeper put in 146.50. Should have been. I know what part of it is. Included in the balance per books is $310, which is what? Cash on hand. Yeah. Because they've got it in the checking account, I think. That's my guess. Cash on hand, how much?
310.
310. So that's going to get us close now, right? So add the cash on hand. to the adjusted balance. They did give you a little twist, didn't they? How much is that? 11,149.
Yep.
What's the difference between 11,149 and 11,185? Is it 36?
Yes, 36.
We went the wrong way with the 18. See? Divide by 2. See what I just did? The difference between these two now is 36.
36. Okay.
And I just divided it by 2 to see if we had a debit as a credit. And guess what? Divided by 2 is 18, isn't it?
Yes.
See that? So now, what happened? Let's reread that. Maybe I went backwards with it. What was the error that they had?
The bookkeeper improperly entered one check in the book at 146.50, which was written for 164.
Oh, we should take 18 away, not add 18, right, guys?
Right.
She wrote the check for 146, or it was written for 164.50.
Yeah.
She recorded it for 146.50. I read it backwards, didn't I? That's deduct, isn't it? And we got it. Okay? So that was kind of cool, actually, that I screwed it up like that, because you saw that dividing by 2 really pays off, doesn't it? I know. Okay. So now what's my adjusted balance here? Balance per books. 1149, right? Whoops, 1114. Did it work? So we got it. Okay? So you had to remember to put the cash on hand in, but you know what? I didn't do that. We would have been off by exactly 310 if we'd done everything else right with it. And then we pick that up. Now they want the journal entry. What's the journal entry necessary? Who do you make journal entries for? The bank or you? You. What do we need? We need journal entries for those 3, right? That's it. And just make 1 entry. I know the authors always use 3 entries for stuff. There's 3 transactions or 3 items, so I'll make 3 entries. I've never, ever seen anybody in my life do that, okay? Why would you make 3 journal entries when you can make 1? What do you want to do? What do you want to do for, what do you want to do to cash? Make it higher or lower? This is what's on the books, 10,147. You'd like it to be 11,149. What do you want to do? How about debit cash, huh? You guys agree with that? How much is that? 104 or less 20, less 18, whatever that is. 1002, is that what that is?
Like 1040 minus 18.
Well, just take the 11,149 less 10,147, right? This is what's on the books. This is what I want it to be. True? It's the difference. $1,002, I think.
Yes.
I went to debit cash. $1,002. Okay, what else do I want to do? I have the error on the supplies. I am reducing cash and I'm increasing what? Yeah. And what was the expense called? The problem there? Supplies expense?
Yeah.
Yeah, it should be higher, shouldn't it? Cash should be less. So that's debit 18, the supplies expense, credit cash 18. But the credit's included in that overall cash adjustment, right?
Mm-hmm.
Okay, what else do we have? Note and interest. And service charge. You want to do the service charge? Service charge expense? How much was it? 20, right? What else do we have to do? 1,040 of note and interest. How much was the note? Note receivable. How much? 1,000. And $40 of what? Interest what? Revenue. Right? I earned it. Ta-da, I'm done. Okay? All I'm doing is making the adjustment I needed, right? I got it there. Did you get that one right? Yes, of course.
So like, what's with like the disbursements and the receipts and all that?
Well, I had to figure out what the balance was in cash. Beginning balance 1050 plus 35 less 34,903. But you wouldn't use it in a reconciliation. What for? I wouldn't use any of the deposits or checks clearing from the bank statement either. We both know about those things. right? The difference between them is the outstanding checks and the deposits and transfers. Yeah, that's it. You just kind of relax and do it, I guess. Is that fun or what? That'll be fun if I give you some of those. I either will, I'll either give it to you on the test just to play this right. It'll be somewhere, or the final. So what else do you want to do?
What's this whole like impairments thing?
Oh, one other thing on that problem, it said how much would you show as cash on the financial statement of the balance sheet? Well, how much cash do you have? 11,149. Would you only show the 10,839? Of course not. You'd show the full amount of cash because the cash on hand is included in that, right? Petty cash and cash in a check register probably. Okay, or cash register. Okay. Okay, the stuff we can do here. Want to do an impairment?
Yeah.
Okay, like on 726 or 727, either one. 726.
Yeah.
Impairments. Okay, these guys borrowed $62,092 from Paris Bank, sending a 5-year, $100,000 zero interest bearing note. Is there such a thing as a zero interest bearing note? No. They got $62,000 and they're going to pay them back 100. I think there's a lot of interest in that note, right? It's 38,000. The note was issued to yield 10%. So if you discounted 100,000 for 5 years at 10%, you would get 62,092. That's all they did. You guys realize that when you look at it? Looks reasonable, doesn't it? Unfortunately, during 2016, they experienced financial difficulties. As a result, Paris Bank determined it's probable that it would only receive $75,000. Market rate of interest on the loan is now 11%. What would you do? Figure out what the value is of the $75,000 now and reduce the value of the loan down, right? From 100,000 to that amount, right? Okay, but this is in December 16th. So, this one's a little bit more difficult. Okay, so here we go. What would they have done? We're doing the bank's books, right? What would the bank have done when they loaned the money? Let's do that. Prepare the issue to record the issuance of the loan at December 31st, 2014. What'd they do? They gave up cash, right? Credit cash? How much?
62,096.
And what would be the note receivable?
That's a whole 100,000.
Yeah, or you could just put in the 62 and the discounts in it, right? But let's do it with the discount account. I kind of like that better. You can see it a little better, right? And if you get your own choice, do it whichever way you want. No problem, right? For me or for the CPA exam. Note receivable. So I like doing 100,000 there myself too. And then what's the credit for 37,908? You know what it is? What's that? What do you call it when the bank discounted the note at 10%? This is not a zero interest bearing note, is it? This is 10%. I don't know why they said it like that, but what is this? They discounted at 10%. It's discount on notes receivable, right? That's a contra asset account, isn't it? What's the carrying amount of the note? Of course, it's 62,092, right? Okay. Now it's 10% interest, isn't it? You guys tell me, what would you have done at December 31st, 2015? That's what makes this one hard. And when did they find out that they're going to have the impaired value? December 31st, 2016? I have 2 years of what first, you guys? 2 years of what first? This is good. Just let yourself think about it. Let yourself think about it. What happens every year that goes by? They borrowed money for a number of years, right? Well, the bank loaned money, right? Your customer borrowed money. For how many years did they borrow it for? 5 years. How much time is gone by?
30.
Only 2, isn't it? 15 and 16? I think it's 2, yeah. You're right. Yeah, 14, then 15 and 16. Only 2 years. But what happens every year? Every day that goes by, what happens? There's interest, isn't there? And what will they have? Interest expense or interest revenue? They're the bank's loaning the money out. What do they have?
Interest revenue.
So each year that goes by, assuming we're doing annual financial statements, assuming the interest is compounded annually, and that's how they discounted it, so it must be. Okay, what would we do every year? Record the interest expense, or interest revenue, right? And on the borrower side, they have the interest expense. Can you tell me how much and how you'd record it? How do you record interest expense? Debit or credit?
Interest revenue or expense?
Oh, I'm sorry, interest revenue. How do you record interest revenue? With a credit, right? So I'm going to credit interest revenue, and then we just have to know how much. What am I going to debit? They're not giving me any cash. They're giving me the cash later. What's going away as I do this? I'm gradually increasing the carrying value from that 62,092 up to 100,000 over the 5 years, aren't I? Remember amortization, right? The discount. So isn't the discount going to go away? Over, yeah. And if I do this journal entry 5 times, the discount will go to nothing, won't it? Just like on a bond. How much is the amount? How much did they borrow from me? 62,092. Am I right? How much interest am I charging? 10%. Can you tell me what 10% of 62,092 is? Of course you can. 6209. 6209, and we'll leave out the techniques, but of course you can use it in real life. Okay? It works, doesn't it? Do we now have a different carrying value on the note? Of course we do. What's the carrying value now? I had 62,092 as the carrying value, which was 100,000 less than 37,908, right? But I just reduced the discount by 6209. So what did I do to the carrying value? Increased it by 6209, didn't I? Right? You got rid of some of the discount. So now it's 100 less about 31,000, isn't it? You got the idea? So it's going to be 62,092 plus 6209. Are you staying with me? Okay, so what's that? 62,092, and I just amortized 6,209 in the discount. So it's starting to approach, moving towards the 100,000. How much is that? 68. Great. So the next year, what am I going to do? Well, I got 10% interest on that, don't I? That's how much I now, right? They now owe me more because they effectively borrowed the interest from me. Does that make sense? Both of you? Okay? So I think that's the new reduction of the discount on notes receivable, and that's the new interest revenue. We're there. 680,830. Is that right? Yeah. Okay. What's the new carrying value on the bond, or bond, on the note receivable? Now at that point, what's the new carrying value?
75131. Is that right?
Did you get the same number? 68301 plus 6830.
Yes.
All right. Now what? I'm going to find out that it's impaired. And this is immediately after I do that interest, and you could make it all in one journal entry if you want, right? It's the same date. But it's a little easier to see this way. What is the value of the note now? Well, now what do I need to do? Discount the rest of the note. So what it says, we're working on exercise 726. What it says is, the note, okay, it is probable that they would receive back only 75,000 at maturity. So what's the future value? 75,000, right? I have a future value when? When's maturity from that?
2 years from now?
2 or 3?
3 years.
3 years from now. It was a 5-year note, right? And here's year 1 and year 2. So there's 3 more years, huh? a future value 3 periods from now, you like it, is gonna be 75,000, isn't it? Okay, I told you we use present values for everything, don't we? Present values and future values. And it's, the discount rate's gonna be 11%, so what do we have? N equals 3, interest rate equals 11% for the riskiness now.
Why is it 11 now?
Well, because they think the market price on the loan of this nature is 11%, not 10.
Oh, okay.
Right, yeah, so the new market, what happened was the market interest rate changed. And also their risk levels probably changed, because guess what, they're not paying, right? So you're gonna get less and they're more risky, okay? So it's 1 over 1 plus the interest rate, right, 1.11, raised to the third, isn't it? And we discount the thing. So you could go look up factor for 11%, 3 periods if you want, or you can just calculate it, right? 1 over 1.11 raised to the third. What is that factor? 11%, 3 periods. 0.89, 0.75, 6 something.
In the calculator, it's 54,839.
54,839.
Yeah, there's decimals, but.
All right. Sounds good. Okay, so that factor is, I don't know, 0.6 something.
The present value, the
Yeah.
dollar, 3 periods,
Present value 3 periods, 11%.
0.73119.
0.73119. I bet you 0.73119 times 75,000 is 54,839. You're close, right? Got it? So what's the deal? The present value of that, the book value, the carrying value or book value, right? Say book value maybe. Carrying value or book value is 75,131. We are going to write it down to 54,839 because it has a permanent impairment, right? So here's my impairment loss. There's so much in all these chapters, there's no way to cover it all, but just no way. You figured that out, haven't you?
Yes.
And, you know, and we're going slow, too. Most schools do 14 chapters a semester. They cover this entire book in 1 year. They don't really cover it. They don't really. So what's the difference between 75,131 and they leave a whole bunch of stuff off, all hard things. And 54,839, what do we have? 20.
2292.
All right. That's how much I want to write it down, don't I?
Yep.
Okay, journal entry to do that. At December 31st.
Would you increase your discount, or would you write it down?
Yeah, what would you do? Well, we could have not recorded it with a discount in the first place, and then you just adjust it, right? But seeing as we used a discount, how much are they going to pay you? Let's do the discount approach. How much are they going to pay you? 75,131. So what do you want to reduce the note receivable to? Well, yeah, but what about the note itself? How much are they going to pay you? 75. So if you want to use the gross amount as the receivable less the discount, what would you do? Let's adjust the note itself, note receivable, down to what? Down by 25,000 to bring it down to 75. That's a nice point. Yeah, you could do that, right? I've got 100 in the account. So right now, here's where I'm at, guys. I have a note receivable with 100,000 in it, and I wish it was what? 75,000. What would you do to it? Reduce it by 25, right? That's the first entry. That's what we just did. That's credit, okay? What do we have in the discounted notes receivable? We have 75, whoops, we have the difference between 100 and 75. What would have been the balance in my discount? I started with how much? 37,908, is that where we started, guys?
Yes.
Okay, so we started with 37,908, then what'd you do?
Added 6.
Well, it took out,
Took out.
yeah. Reduced it by 6209, right?
And then we reduced it by
24,869.
And reduced it by 6830. And what do we have in there?
24,869.
And what was the difference between 100 and 24,869? That's the 68,301 carrying value we've got, right? You guys with me?
Okay.
Okay. What did I get that right? Where did I get a book value of 75,131?
Because we added the 6830 plus the 68301, which gave you your 75,131.
Oh, okay, yeah, I've got to add the other one, I apologize. So what's, that would be 75,131, that's right. What's 100,000? Less 724,869. 75,131. So that was our carrying value, wasn't it? Okay, and now we decide it's only worth 54,839. So what we could do is we could reduce the note to 75 and then make the discount be how much? What do you want the discount to be now?
Increase by that 22, or, wait.
We want the difference between the 75,000 note and the discount to be what? 75,000 less 54,839 is how much?
2161.
2161. So the difference between the 75 here and the 2161 is our new carrying value. We want at 54,839, right? So I'm going to have to debit the account for how much?
Okay.
4,708. Is that what it is? Oh, all right. So then I debit the discount. See, you made it hard on us. Okay, that's okay. That's because we use that discount account. We can debit that much. 4,708. And what is the difference? What's the difference between 25 and 4,708? It's the 20,292 impairment loss.
Oh, yeah.
So is this what we're gonna have to do with this?
Nah, I'll probably just show you what the carrying value is and you just adjust it, right? But this is not a big deal, is it? Right? Here's what I want. I'll probably just ask you what the impairment loss is or something, right?
Okay.
Or if I had the note recorded at net instead of using a discount, you just adjust the note for the 20,292 with me.
Yeah.
Right? This is kind of a neat little twist, though, huh? They do stuff like this to you on the CPA exam all the time. Who cares, right? What I want is what? I want the new note to be 54,839, and I want my loss to be 20,292. That's where I'm going, right?
Yeah.
And I accomplished both of those things, didn't I? What's the difference between 75,000 and 2161? So 75,131, right?
Wait, say that again?
Or no, it's the 54.
Yeah.
It's the 54,839, right?
Yeah.
That's that. So that's where I want to be. Okay. So you can, if you can see the big picture, you got it made. So who cares if I do it that way? I'll probably give you more points if I do it that way. You have to think your way through it a little more with you. Okay. But if I had one account with 75,131 in it, and you want it to be 54,839, it's an easy entry. It's debit loss, credit note receivable. Yeah. This is debit the loss and credit the note receivable, isn't it? Right? Put those two together, that's 2292, isn't it? Does that work? So this is a good mental exercise. Good mental exercise. And I'm not just doing it to you to be mean, right? Like I did in 102, but that was just fun. Yeah. Okay. Let's see. Let's see what we can do, guys. Towels. Nice. You want to do some,
Have you done aging bad debts yet?
no, do an age.
Okay, on capital property?
How about, what are we doing that one? Oh, that was annoying. Exercise 711. That'd be a fun one. Who's the following accounts, and they have all kinds of different dates. Oh, there's one account. Age the balance and specify any items that require special attention. That'd be a good one for you to work. So 712, these are really cool. And there's assignment problem. You guys can just work. I'm looking for one where you actually age the receivables.
I don't think there is.
I think there's a problem that does it. Oh, how about, let's do the 173. Have you guys tried that one yet?
Which one?
P73?
Yeah, P73. What is the approximate balance in the allowance? And then show how accounts receivable will be presented. What is the dollar effect of the year-end bad debt adjustment before tax income? Go ahead and do that one. Give it a shot. See if you can do problem 7-3. What I want you to do first is come up with your estimate, just like it says, what is the appropriate balance in the allowance for doubtful accounts? Okay? And then assume, do we have an ending balance? Yeah, it has a credit balance, right? Accounts receivable is $555,000, right? I assume all that adds up to $555,000. I'm sure it does. And they got a credit balance in the allowance of 40. Make your journal entry then too, right? And then answer how would it be shown on the balance sheet. So add making the journal entry, do that. And then what's the dollar effect of the year-end bad debt adjustment on the before tax income? Well, that's what your data is, right? Bad debt expense. So can you come up with it? What percent are you going to not collect of each of those groups is all you can do. This is actually pretty simple. got one? Got a number? You do here. It says under 60 days, we think, oh, wait a minute, nope, wrong number. Less than 16 days. Their terms are what? They don't say, do they? What do you think they are if they think current is less than 16 days? Probably 15 days, right? Even 15 days. If you go over to 7.5, I jumped over there, I said under 60 days, what do you think their terms are? 60 days, right? So current, that's it. Okay, so less than 16 days, there's 300,000. So what would you do? All right, so
Take that 300,000.
1 to 16, you take the 300,000 times what?
0.02.
Yeah, because 98% is going to be collected, only 2% is not. So here's your allowance that you want for that one. That's all there is to it, okay? So there's the accounts receivable, the portion that you're not going to collect, how much is that? 6 grand. So I want to have an allowance of 6 for just those, okay? So it's a little more refined than just taking a percentage of the total receivables, right? Okay, and then 16 to 30 days,
That's going to be 10,000.
and 100 times what?
0.1.
Oh, 10%. Would it make sense that, you know, the longer it's past due, the more you would collect? Okay, that's another 10 grand. Okay, they think they're going to collect most of the current stuff. And then 31 to 45, that's a 15-day group. Oh, I guess they all are. And what's that, 40? 80. What percent are they not going to collect? 15%? They're optimistic. Okay, anyway, so how much is that? But it might be their history, right? How the industry works, how their history works. Okay, that kind of thing. You make as good an estimate as you can. Okay, 46 to 60.
40,000.
Yeah. What portion?
Would you say that, I don't know, I would think it would be 60 because they said it was a high risk anyways, or a high rate of bad debts. So,
Yeah, I think they're pretty optimistic.
okay.
Yeah. But I don't know. They don't think they're going to collect anything over 75 days, though. So there's going to be a chunk of, there's going to be a big allowance. This is only, what's their receivables, 555? We can figure out what the total percentage is when we're done here, but it's probably pretty big, isn't it? I don't know. 61 to 75, how much was that? Luckily only 20,000. And we don't think we're getting much of that one, right? 45%?
Yes.
We are not getting? Okay, so almost half. How much is that? 9? Okay, and then everything over, right,
Yes.
is 15,000 and the whole thing goes across. Okay?
Now, would you just end up writing that off? Or
No, we can't write it off. We don't know who's not going to pay us.
Okay.
It's an allowance. Writing it off is debit, allowance, credit, accounts receivable, isn't it? Can't write it off. I don't know who it is. If I knew it was, I wouldn't have sold to them. Right? They do an allowance method. So what all does that up to?
All those add up to 60.
Is that what you guys got too?
I got 45, but I didn't do the overtime.
Ah, yeah. Okay, that makes sense. They got to pick it up, right? Okay. So what do I want? I want my I've got my accounts receivable is how much?
As 555.
So maybe that's not too much, 60,000. That's not too bad. And my allowance now has what in it?
It started with 40.
And what do I want it to be?
60.
Can you give me a journal entry to do that?
Yeah. Credit to allowance for doubtful accounts, debit to bad debt expense. 20 to 20.
Okay. Can you show me then what we would have on the balance sheet? How would you, that's what it asked for. It didn't ask for the entry, but you have to do the entry, I guess, anyway. How would the accounts receivable be shown on the balance sheet? What would you show?
Net accounts receivable.
Well, first you show accounts receivable of how much? 555.
Yeah.
And then what would you show?
Allowance.
Allowance for doubtful accounts. That's what they're asking for. How much? 60?
Yeah.
And what would that give you? Net realizable accounts receivable. Right? How much is that?
1.
So that's what you do. That's what you tell them.
Could you, like, just, if you were to ask this question of how it would be presented on the balance sheet, Could you just say net realizable account
No,
receivable?
because that's not how you show it. You show this, this, and this. Got it. Or you can show it parenthetically, but you gotta disclose it. You gotta tell them that 555 is your receivables and
That's
60
a-
is your allowance. Yeah,
That's what
they wanna know. Yeah. Okay, shareholders wanna know. So I'd do it like this, absolutely. You could do parenthetical, you said accounts receivable net, and then in brackets, 60,000 allowance for doubtful accounts, and then show the 495. That's okay. It's much, just as much work as this is, isn't it? Okay. All right. What's the impact on the before tax income? 20,000. Let's say I was in a 30% tax bracket. What's the impact on a reduced income? What's the impact on income after tax if I'm in a 30% tax bracket? You'd put 20. You'd put 20 on your tax return, right? Reducing your taxes or reducing your income. Would you reduce your taxes by 30% of that, which would be 6, right? All it is the 20,000. You're right, 14. All it is the 20,000 times 1 minus the tax rate. Every expense has that impact, right? Every revenue has the same thing, only it's increasing income. Revenue times 1 minus the tax rate. Easy questions. True? You could do that too. Okay, now write-off. Let's say that we find one for $5,000 and write it off. What would be the journal entry? I now have 60 in this account, right? I adjusted it to 60. I now find 5,000 and I write it off. One of them's bad. What do you do for that? That's not just problem either, but you need to know it.
Debit to allowance.
Hey,
Keith,
Keith,
it's just not your day.
Keith,
Yeah.
I didn't do the over 15 at
Yeah.
the beginning, but I still got the net.
That's because you made your allowance 60.
I did it for 540.
Oh, you wrote off the 15.
Yeah.
Oh, you know what? You could probably do that. I don't mind that. Well, if you think you're not going to collect any of those,
Yeah.
you don't have to allow for it. You could write it off. You're right. That's not bad at all. You could write it off, couldn't you? And maybe, do you have, anybody have a computer with them? I can call up the answers, but they might have done that in the answer. I didn't think about that. Because it's 100%. You're sure you're not getting it, right? So what you could have done, and that's great. I like that.
For my accounts receivable, I had 540, and then allowance for
Yeah,
doubtful, I
because
did
you would have made a
45.
journal entry like this. You would have debited allowance for doubtful accounts for the 15 you're going to write off, and credit accounts receivable for the 15 you're going to write off. Okay? So you take the 15 out of here, and now you have 540, right? But what else are you going to do? You're going to take the 15 out of here, and now what do you have here instead of 60? 45. And you'd be just fine. So after the write-off, you'd have 540. I think it's a better answer. Less 45. It's, guess what? 495. That's what you did. I like it. I think you're right. Why do I think she's right? They're sure they're not going to collect it. They should write them off, shouldn't they? They shouldn't allow for it. They should write it
That's
off.
what I said right at
Is that
the
what you did?
beginning. Yeah.
Okay. Is that what you did too?
But if I do it this way, I still get full credit.
No, probably not. I screwed it up.
Sorry. Bro.
No, what frustrates me is I said it before, and then he was like, "Oh no, that's a stupid idea."
I
And now we coming
No,
back.
I didn't.
Yes, you
I
did.
I never.
I said, "Hey, should we write off these because there's no chance of us getting?"
Oh, I
them."
thought you meant all of it. I thought you meant the whole all
Oh,
of these
come on.
up here.
No, that doesn't even make sense.
I'm supposed to read your mind. Well, it doesn't make sense. I don't want to write these off up here because I don't know which ones they are.
Yeah, that's.
I know which ones those are. Sure, you can write it off. Okay? That's not a good way to do it. Don't you think we should write off the 15?
Yeah,
I bet if you look at the
I mean,
answer, that's
yeah, but
probably-
at the
Get-go.
same time, like, if it gets me the same answer,
It doesn't.
and I show you the word,
It doesn't get you the same answer. Because it's really 540 you have left and 45, right? It is. They're right. We're wrong. We'll live with it. Okay? So.
Technically, you have to do less work. You don't have to calculate the
Yeah.
15.
You have to put the 15 in. Yeah. Well, if you were doing journal entries, though, your journal entry still be for your journal entry, it'd still be the 20, right?
Yes.
What do you have for bad debt expenses? At 20? How much? Their second question, or third question. What is the dollar amount of the effect of the bad debt adjustment on before tax income? It's 20, isn't it? right? Did you pick that up?
I didn't get that far. Give me 1 second.
Oh, right, okay, so it'd still be 20, wouldn't it? Because we really have this journal entry and this journal entry, right? Yeah, all right. Okay, isn't there a need accounting fund?
I don't really care about that. I'm bitter. I have to do it that way now instead of my way.
I'm bitter because I forget.
But you see why this is better, right?
No, I see why
If
it's
you don't,
better.
if you're 100% sure you're never gonna collect it, you can write it off, of
Yeah,
course.
I mean, I see where you're coming from, but at the same time, it's like,
Just one more thing.
it's my way.
Well, this is a CMA question, right?
What is CMA?
Certified Management Accounting exam. Yeah, I mean, this is a tough question, okay?
Really?
So, yeah, it's pretty tough. They don't mess around. Well, they threw a couple twists in there, didn't they? What's that? You thought it was easy?
No, she thought it was the country music awards.
Oh, yeah,
That's true.
that's good.
I need to get a bathroom.
That is fun. Okay, what if we wrote off a $5,000 account here? That's the same entry as this, but if we wrote off a 5,000 account, what would we do? Debit what?
Allowance for doubtful
Yeah,
accounts.
to write them off, you debit allowance for doubtful accounts, and you credit,
Accounts receivable.
yeah, so we do that.
But if you find out they're gonna pay you, which is the next question you're gonna say.
That's right, what do
is
you do?
Put it back on there and you say accounts receivable, debit.
So if you think 3 of that's gonna be collected after all, what do?
I was ready for it, I knew it.
Debit, you put it back into accounts receivable when they tell you they're gonna pay you, and credit what? Put it back into the allowance. You just reverse it, big deal. Remember this stuff? You didn't know it for the chapter 3 quiz, but you know it now. Yeah, okay. So we're just undoing that, okay? Then when they pay us, what would we do?
We would get cash.
And credit,
The accounts receivable.
okay? You guys agree with that? What if they told me and paid me at the same moment? They sent me a check. What could I do? Debit cash and credit allowance. It looks funny, doesn't it? But you don't need that. You do it all at once. You could just debit cash for 3, because I got it, and credit the allowance for 3. And of course, I do it that way because I'm a very lazy person. I would never write down 4 lines when I could write down 2.
I don't like that.
Then don't do it that way. This is just fine. You can reinstate it. This is called reinstating the account, the first entry, and then, of course, it's a cash receipt after that, right? So write off, reinstatement here, right up here, reinstatement, and then cash receipt. But that just combines them and saves you a little bit of time. It's no big deal. Okay? What we got to get so is we just think, right? We just think, and who cares? Okay, if this approach over here occurs to you first instead of this, what difference does it make? You're done anyway, right? You're on your way.
If you end up with a debit and allowance for doubtful accounts,
Oh, yeah, how could that happen?
well, if you write off, write off?
My eraser allows me to extend the page. That's pretty cool. Okay, anyway. I have never had this happen. I get something new all the time. I must be hitting something somewhere that really. Okay, yeah, what happens if you get a debit balance in your allowance?
You find more accounts.
You know, you have an allowance for doubtful accounts. What was it, 60,000?
Yeah.
But,
Well, there you go.
right.
Your eraser's letting you write now. It's just doing everything.
There we go. All right. So I have 60,000 in here, and then I write off 70,000, right? So you would debit allowance for doubtful accounts for 70, and credit accounts receivable for 70, wouldn't you?
Yes.
And you have a 10 in here. What are you going to have to do next time you replenish the account? At the end of the next year, you want this to be 80. What's your entry going to have to be? 90. That's it. Debit, bad debt expense, credit allowance.
So when you show that on a balance sheet, would you end up technically adding that to accounts receivable?
Oh, no. Yeah, I would never do a balance sheet with a debit balance there. It doesn't mean anything. It only has a debit balance because you haven't replenished your account yet. As soon as you make the entry to replenish your account, what happens? I have
Your expense went
reducing my expense by the 90, which is reducing my income by 90, which is reducing my equity by 90, and I have reduced my assets, right, by 90. Even though there's only 80 in there, I reduced them by 90, didn't I?
So where would you show that 10 at? Would you just
Nowhere.
Just wouldn't show
That
that?
doesn't go on a balance sheet
Okay.
in the general ledger at the moment. It doesn't matter what the numbers are in the general ledger unless you're doing a financial statement, right?
Yeah.
So we end up with that debit because we wrote off more than our original
Well, I know.
balance.
What I'm saying is, if it's year end, and that 10,000 is there.
I wouldn't do a financial statement until I replenished the allowance for doubtful accounts. Because otherwise you'd be missing this 90 on your income statement, and you'd be showing the wrong amount in your balance sheet, and you would have overstated your assets by 90, right? Overstated your equity by 90, understated your expenses by 90, and overstated your net income by 90. That's what you would have done if you don't make the entry first, right? That's it. Okay, good question. You're turning colors?
No, I sat and watched the baseball game before this. And I was sitting out there and I had my sleeves right here.
So you're proving that black people do indeed get tan. It's
There's
yourself.
literally, I'm going to show you because this is really funny.
You know what I guess is really bad is that you never think about it when
We burn too.
and you live around white people when you're a kid.
I
I never
burn.
thought that black people would burn. They got dark skin. Why would they burn?
I'm not gonna
Right.
lie.
Look at this, Keith.
I have the same thought process.
That's,
Yeah, amazing. Wow, you're getting a tan.
I know, I'm so mad.
But
It's
they
so
can,
uneven.
they can stay out there for like
We
an
can
hour.
stay out longer and not use sunscreen.
Yeah.
But if we're out there for
Really?
like 5-6 hours, you'll
Okay,
burn.
so the pigmentation does help.
Yeah.
Well, that's probably
No,
because
you just don't
you're
turn red. You'll just like, you'll touch it, you'll hurt. It hurts and you'll peel.
okay. So is that because you would reflect light more or absorb light more?
Absorb.
I don't know. I
No,
just
it's
know
absorb.
I burn.
It's a
Wouldn't dark absorb? Like, oh yeah, a black car gets hotter than a white car, right?
Yes.
Okay, so it's absorbed. Yeah, okay. This is, we're recording this racist conversation.
We
right?
really are.
Yeah. We're recording our racist conversation here. Why would that be considered racist, by the way?
I mean, I don't
I had
like
noticed
it.
that you're black. Had you?
Huh?
I had noticed that you're black. Had you noticed that?
Yeah.
Yeah, I know.
She knew that when she.
We're supposed to pretend nobody's
When I was
a
born, I was like,
minority
what
in the
color?
world yet. It's not a
For like the
problem
first
though.
like 2 months, I was your color.
What I think is really entertaining in the current election is starting to show that the majority white folks are going to be in the minority in this country, and in some states we're already there. It's really fun to watch that happen. No, 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 no! They can't take our rights away. Oh well. So nice being a melting pot country, I think. Great.
I'm really upset
Bring
about
people in
this.
from everywhere. She's upset. Yeah, okay.
'Cause it's like,
What else do we need to do? Anything?
everything has to be right.
I did notes with an unrealistic interest rate, didn't I? You want to do a signed accounts receivable? I did talk about that though. I did not. I did or did.
What was this supposed to be like, Keith?
Like,
Painful.
I-
Painful.
Problems probably mostly. Yeah. I haven't written it yet, so.
You're not gonna make us like write out definitions or anything, right?
Oh, I might.
No, that's not mine.
That's possible. That's a good
Are you
idea.
kidding me? Why would you even give him the idea? Like, he was probably like thinking about it, like, I'm going to tell them all this stuff is really important, and it's just going to be 1 page of definitions.
That could happen.
definitions
That's
are
happened
important.
before, hasn't it?
No,
Yes.
he hasn't done it to us yet.
Yeah, he has.
I mean, he put that one on there, but it
No,
wasn't
he put like a whole page of definitions.
I know, it was only like 5 points.
But he didn't tell us that definitions were gonna be on it,
Yeah.
or steer us and give us like a hey, like.
What I think
Really
is
look
fun
at
is
this.
when I put them on the final. We could do some factoring, or we could do some assignment,
Do we lose?
or we could do. You want to do a comprehensive kind of strange problem?
How is this only one chapter?
I know it's a lot of information, isn't it?
I totally forgot we talked about cash on Monday. So, like, I started doing some of the... I did the reading on Tuesday, and I was like, what the throw is this? I feel like I'm about accounts receivable.
You want to try and do.
I'm waiting for to get the text messages after the speeches pages for the, oh my God, will you
How about the
write-
comprehensive receivables problem on page 398, problem 710? Let's do that when we get out of here. I bet we can't do it that fast. Maybe we can. Okay. So it wants to do the long-term receivable section of their balance sheet.
710.
Yeah, I'm looking at 710. So if you look on page, what I would do is I'd look at a problem like this, and I'd read just the beginning. They have the following long-term receivable account balances: no receivable from sale division, no receivable from officer. Then it says transactions. Then I would go over to the instructions. Right? It's way too long to read it. Okay? I'm going to read it as I do it, kind of. So I want to know what I'm doing before I go there. Prepare the long-term receivable section of their balance sheet. Okay? Prepare a schedule showing the current portion of long-term receivables and accrued interest receivable that they have. And prepare a schedule showing interest revenues from long-term receivables that appear on the income statement. Holy cow. So I want interest revenue, I want interest receivable, right? And I want to know how much is long-term and how much is current, I guess. Oh, it's all long-term. Okay. Well, maybe it's not. I just want to know the long-term. So where would you start with something like this?
The T accounts for the.
Yeah, maybe so, and just adjust for it. That'd be really fast. I think you probably. All I wanted to know is the balance and how much interest there is, right? So let's do, you want to do a T account for note receivable from sales and one for officer?
Yeah.
Okay, you can start there. That's not a bad idea. I like it. Note receivable, what is it?
Sales.
Sales. And?
The receivable officer.
And you know what, we may have more, I don't know. Okay. We'll see. All right, and it's $1.5 million and $1.4 million?
No, it's just 4.
For 4?
$1.5 million and then 4.
So they think they have $1.9 million, it looks like, huh? The $1.5 million note receivable dated May 31st bears interest at 9%, represents a balance of consideration received, that's value received, right, payment, from the sale of Braddock's Electronics Division to New York Company. Principal payments are $500 plus appropriate interest are due May 2014, 15, and 16. The first principal interest payment was made. Excuse me. Collection of the note installments is reasonably sure.
Okay, so we need to decrease it by 500,000.
Already they got paid 500. Which should you reduce it by 500?
Yeah. I mean, you know, oh, no,
Oh, it's plus interest.
yeah.
So yeah, I guess you would, right?
So-
So it bears interest at 9%, but it's not included in it, is it?
Yeah.
So the amount of $1.5 million was right, except they failed to record the payment, right? What they should have done is debited cash for $1.5 million, or for 500,000 rather, plus whatever the interest is, 9%. Oh, by the way, we want to know what interest is too, don't we? Do we want interest expense too, or interest revenue?
Interest
Oh, they owe us interest revenue. We better do another T account named. How about interest revenue? Okay. Do they want interest receivable too?
Yes. So I might as well make a T account for them.
Might as well do that so we get them all. Okay? Getting the idea? And then you can put them all into a schedule once you got them. Okay? So what would the journal entry have been? If you just think about journal entries, this might work, huh? What's it going to be? Debit cash?
Debit, well, yeah, debit
Don't
cash.
look at me so skeptically. You can do this. Looking like you're crazy. Okay, debit cash, right, for what they're going to pay me. Credit note receivable,
And then credit.
sales division. That was 500, right? And then credit, interest, revenue, right? There's not going to be interest receivable here. We don't need one. Okay, right? How much is that going to be? 9% of the $1.5 million. What's 9% times 1,500,000? $90,000 plus 45,000, 135,000.
Yep.
Cash, 635,000. You guys agree with that? They could ask us all kinds of questions about
So, you would pay interest on the whole $1.5 million, not just the 5. I'm sorry,
this.
but
Would you loan me $1.5 million, and then when I make a payment on 500,000, I'll just give you the interest on the 500,000. You just let me have the $1 million for free. Really? Thank you, thank you, thank you. That'd be very nice. I want to do business with you. Okay? So what do? Take 500 out of here, right?
Oh, okay.
And put 135 in here. Going good, isn't it? And you can do a little schedule where you said what they were, right? That's what they want you to do. Okay? That's that one, isn't it? Collection installments is reasonably assured, otherwise what would you have to do? Discount it, write it down, and do something, right? Okay? Set up an allowance. If they don't want an allowance on this, do they? Or do they? No, they don't say. You could do one. Prepare the long-term receivable section. You may need an allowance. We'll see. That one you don't need one. The 400,000 note bears interest at 8% and is due on December 31st. The note is from Sean May, President, with collateral by 10,000 shares of their common stock. I have a note receivable that is collateralized by my stock. Is that collectible? By my own stock. Braddock's, yeah. They owe me money. I have a note receivable, and the collateral for it is me. It's not very collectible. Interest is payable annually on December 31st, and all interest payments were paid on their due dates through December 31st, 2014. The quoted market price of our stock is $45 a share. All right. What's $45 times 10,000 shares? So what we could do is take the stock from, sell it for $45, right, a share, and we would get how much? 450,000, and they only owe us 400,000. What do you think? We're okay, I think, on this one, right? I think we're safe, don't you?
Yeah.
What if it's less than 400,000? We would have to have an impairment of the receivable down to the market value of our stock, wouldn't we? It's publicly traded, which is good. What if it's not publicly traded? Uh-oh, tough, huh? Now it might not have any value at all. I mean, it does, but we don't know what the value is. You got the idea? It'd be hard to measure. So they gave us a value. That's nice, and I like it. Okay, and they've been paying interest on it. So it's due December 31st, 2016, and this is the year 2014, right, that we're working on? So what would they have in 2014? What would be the entry related to this in 2014? Debit what and credit what?
Debit cash, credit interest
Yeah,
revenue.
credit interest revenue. You got it. That's exactly right. How much?
It would be like 400,000.
At 8%. They're paying it every year, right? So I think you're safe, and I don't think you have to do a write-down on it. I don't think. How much was the cash? 32. And why do we want that? It's part of our revenue, right? So we can list that too on our revenue schedule. Sound good? Okay, and I think we're done with that one. Boy, that was too easy. I was thinking we'd have to write it down, weren't you?
Give it a second.
Yeah. So this doesn't say AICP adapted or anything, so maybe it's the authors or something. On April 1st, 2014, Braddock sold a patent to Pennsylvania company in exchange for 100,000 zero interest-bearing note. Oh, it just got harder. Okay, and also this is another account, isn't it? What's that one? This is going to be a note receivable from Pennsylvania company, right? So let's add a note receivable from Pennsylvania. Okay? What do we want to do this? There is no established exchange price for the patent, and the note had no ready market. If the patent had a market value, what could we say the note was worth? The patent? No, we say it's worth what the patent is, right? Well, because the patent would be worth less than 100, right? You're not going to put it at 100. Is there any such thing as zero interest? No. So we need to discount it down to what it really is. But what if I knew the patent was worth 80,000? What's the note probably worth? 80,000, and now I know what the discount rate would be. I can compute what the discount rate is to bring it down to the 80, couldn't I? Right? You could solve for the interest rate. Okay, but instead they don't have that. No established exchange price for the patent, and the note had no ready market. But the prevailing rate on this note was 12%. We got it made, and they even gave you the factor. But you go look it up, couldn't you? It had a carrying value of 40,000 at January 1st, 2014. Amortization would have been 8,000. The collection of the note receivable from Pennsylvania is reasonably assured. But they don't even care about journal entries, do they? If we want to do the journal entries, we could. Let's go ahead and do the journal entries. If you get a question that asks you this kind of thing, what would you do? Which we can do it at, well, we can do it in a later chapter. What would we do with this thing?
So we need to discount the patent to a present value.
Yeah. And we're selling the patent. So first, wouldn't you amortize the patent?
Yes.
We have the patent on our books at what? No. It's on our books at
40.
40. So they've written it down to 40,000 over time, right?
Yes.
But then what would you do to it? You would have amortized it for 8,000 this year, wouldn't you? Because this is being done at December 31st, is it? No, they're doing it April 14th. Oh man, it's really hard. The amortization for 2014 would have been 8,000, but that would have been straight line. So if they ask for the journal entry, tell me how much amortization should you do up to that date? And what we do is we debit amortization expense. This is getting hard now. And credit accumulated, or credit patent, not accumulated amortization. It goes straight to the patent. How much is that? 8,000 would have been a whole year, right?
Yes.
And this is April 1st. How many months have gone by? 3. So it is 1/4 of 8, which is 2,000. So what I would have done is I would take 2,000. It doesn't ask for this, but that's what you do, wouldn't you? What's the carrying value of the patent now? 38,000 on that day, right? Then what would you do, everybody?
Wait.
You're going to sell a $38,000 asset, aren't you? And get a note for it. You see why I amortized it by 2,000? 3 months went by. That's April 1st,
Okay.
right?
I thought they had got rid of the 8,000 for the first part, but they didn't.
They've been advertising it
Yeah.
every year for 8,000, right? Okay, what do you want to do now? Sell it. We get a note receivable. But what we need to do is figure out what that note receivable is worth, don't we? And we're going to credit patents, and then we're going to have a gain or loss on the transaction. Are you going to take the patent out at 38,000? Yes, because I no longer have it, right?
Mhm.
So if it asks for the entries, I'd take the 38 out of there. But is my note receivable 100,000 and my gain 62? No, because that note is not worth 100,000, is it?
It's worth 100,000 in 3 years.
Yeah. It's 100,000 discounted at what?
12% for 2 years.
Ta-da. 2 years, is it?
Yeah.
Okay. What's that worth? Easy, isn't it? This is easy. Let yourself think. By the way, on that whack cap in, I want you to, over the weekend, read that paper, work those 2 problems again, and get them right. Okay? And then we probably wouldn't have to talk about it at that. Okay? Did you get those right? You didn't get them right.
No.
Did you get them both right?
Well, no.
Then do the one, you got one right and one wrong or something, or one mostly right? Do them again. It's really a good time to do it. Everybody at home, do them again, right? Do them right away. And that'll you'll really get it solid. Because you're going to see that again on the final. Why not have the points? Okay? Plus, you're a finance major. They're going to crucify you. Okay? Come on. Besides, you're doing it at 3:15, aren't you, right now?
What?
Whack, Captain. Right?
Yeah.
Aren't you in 3:15? Finance 3:15? Yeah, you have Brad?
No.
No, Dan? Yeah. He sneaks up on you. Have you noticed that yet?
Yeah.
Yeah. He's a real nice guy and laid back and slow and casual, and then he expects you to know everything back there. Yeah. So I'm at least intense before I do you. Right. Yeah. He'll just do you. So get it down. It's not that bad. Not that bad. You just have to practice it better. What does that come up to here?
79,719.
That's what I think the asset is worth. So it'd be 79,719. That's what the patent was worth, right? That's what I got for the patent. Got it? That's the market value. This is the market value. If you don't know the market value of an asset, it's the discounted present value of the future cash flows that's going to be paid for it, right? Whichever is more readily determinable. Got it? Everything's worth that. Okay? And typically the discounted present value of cash flows will be equal to the market value. That's why they paid that amount, right? And that interest rate. So people know what they're doing. All right, so what we do, so this is a good estimate of value. We're going to have a note receivable of 79,719, aren't we?
Yes.
Yeah, we got another one. Okay? And then on this one,
We would have
we're gonna have a gain, right?
a gain of
Gain on sale.
41,719.
And I don't think we need that for this problem. But if they did want it, we'd know it, wouldn't we? Okay? So now we got that one, but there's one other piece. What was the date of that? April 1st. Ah, when are we now? December 31st. What are you going to have to do? The other one was as of December 31st, wasn't it?
Mm-hmm.
Oh, wait a minute. No, it's not. I lied. We got to go back to number 1, too, and do that. On number 2, though, it's at December 31st, isn't it? Dated December 31st, so we're
Yeah.
fine. It's on the year end.
Well, this one's May 1st to May 1st.
The first was, yeah, the first one I have 6 months more than that. May 1st, I have 7 months interest in the first one. I got to accrue interest on it.
Well,
You guys with me?
Wouldn't they just pay the interest, so you wouldn't have to, I mean, if you made.
No, you're paying it annually.
Okay, so you
So what are you
establish
going to
it,
have to
and then
do?
you
You're
give
going to
it-
have to calculate your interest. So on the first one, how much interest is there going to be? We're going to have to accrue interest on it. Boy, this is a tough one. After all, I take it back. I've got $1 million note, right? At least the computation's easy. That's the first one, right? And that's at May 1st. You guys agree with that?
Yeah.
How many months to year in?
Oh,
7?
80.
8? 7? 8? 8. It's 8 months, isn't it?
Yeah.
So it'd be 1,000,000 times the interest rate on that first one. 1,000,000 times the interest rate of 9%, which is 90,000, right? Divided by 12 times 8. So it's 2/3 of 90, isn't it? 8 months? I think it's going to be what? What do you think the interest is going to be, you guys? Debit, interest receivable, for 60, did we say? 60,000. And credit interest revenue. There you go. So on your schedule, you're going to have to put another 60,000. You can see how we'd have a lot of points on a problem like this on the CPA exam. It takes you a long time to figure everything out, get a thing through, right? But we have that, don't we? On the second one, number 2, it's dated December 31st. So do we have to accrue any interest on that one? No, because it's the year end, right? So we're done with that one. And this third one, do we have to accrue any interest on this one? About time I realized we could accrue. What do we do with this one? We have a note of 79,719, don't we? By the way, could I have recorded this, the note at 100,000 and a discount for the difference? Yes, right? That'd have been fine. But what's the interest going to be? It's going to be 79,719. What's the interest rate on this thing? 12% is what we discounted at. 12% for how long though? That's from April 1st, is it?
Yes. So.
To the end of the year, that's 9 months, right? 9/12. Right? So take 9%.
Yes.
79,719. And what do you get? We got to accrue that one too. Then we'll look at the answer to this thing and see if we're right.
No, no problem.
Probably screwed something.
7,175.
What's the journal entry going to be? Debit what? Same thing. Debit interest receivable. Credit interest revenue. 4,7,175. Okay, 7,175. Okay. And then there's one more, is there? Number 4. They sold a parcel of land for $200,000 under an installment sale contract. Okay, these guys made a that means they make installments, right? Made a cash down payment of 60. So what did that make the note right away?
At least 60.
Well, no, they sold it for 200, and they made a 60 down payment. So what was the sale? Sale was 200.
260.
But yeah, well, no, I think that's the down payment. They sold it for 200, but they've made it down to 60, so they only owe you 140. Know what that says?
Well, it said sold the parcel land for 200,000 under installment contract. Splitter made a.
60 down payment.
So wait,
they owe
they
you 140.
Or do they have a 200,000
No,
payable
260.
and a 60,000?
No.
Okay.
What does it say? Gotta read carefully. 200,000 under installment, they sold it for 200. They got a 60 down payment and they signed a note at 11% to the 140.
Oh.
The equal annual payments of the principal and interest on the note will be 45,125, which of course includes the interest, right? Because otherwise the payments, I don't know what they'd be, but 40 divided by 4, 35,000, right? So the interest is another 10,000. You guys agree? Yeah, each of those payments. The land could have been sold at an established cash price of 200, so we think it's really worth 200, right? So the interest rate's correct. The cost of the land to Braddock was 150. Circumstances are such that the collections on the note is reasonably assured, so we have no allowance for doubtful accounts on any of these. I'm thrilled, I am. Right, so we don't have to worry about that. All of them, I think all of them are reasonably assured, I think. Yeah. On number 3 it was too.
Yeah.
They're good. I think they're good. I think. Okay. They could have thrown that in there too, and now you have to do an allowance, you know, whatever probability they weren't.
So wait,
neglected.
Did say that to dollars.
They've been paying their interest on due dates, and their profit. And you got the stock. You're not guaranteed, but you're reasonably assured because your stock's worth more in the free market, right? In the competitive market, rather. Okay. Yeah, so we're probably okay. Yeah, that one's probably all right because of that. So what would be the journal entry for this? You don't have to do it again, but let's do the journal entry anyway, seeing as it's so much fun. Okay, let's do the journal entry for recording this transaction. What would it be?
So we would have a notes receivable of 140.
Okay, so wouldn't you debit cash
Well, yeah, you get 60.
for 60? Then you're going to debit notes receivable for 140 because they're going to add the interest to it, right? So it's not discounting it this time. And then you're going to credit what? This is not a sale. We're not in business selling land, I don't think. I think this is land, don't you?
Yes.
How much was the land on our books at?
150.
And we sold it for 200. So what's that going to be?
A
Gain on sale of land. Got it. How much? Sold it for 200. Okay. So all we want is the note receivable here, huh? What was the date of that one? 7/1. It's July 1st, right? How many months are left? 6. So what are we going to have to do? Accrue interest for 6 months?
Yes.
But on how much?
140.
140. And that's it. And they let us know by them telling us that if you could have sold it for 200 means that the interest rate's the appropriate interest rate, right?
Yes.
That's the fair market interest rate because it was really worth 200. What if it was worth 220? Now the interest rate's been modified, right? If it was worth 180, they, played games a little bit there. All right, so I want one more note receivable, don't I? Who was that with?
Splinter company.
Okay, Splinter. So look at this. I've got note receivable sales, officer, Splinter, and Penn Company, right? Then I have interest receivable and interest revenue. So I'm getting everything up here I need for my little schedules, right? Then what else do I have? To accrue the interest, gang. Same entry. Debit interest receivable and credit interest revenue. How much? 140 times what? What's the interest rate?
1%.
11% on number 4.
Oh.
11%? And how long is it for? July 1st to December 31st? Half a year, right? 6/12. Right? How much is that? I'm really curious to see how much I screwed up on this.
I could multiply that by 0.065 or 0.055.
Sure.
7,700.
Okay, that's it. Okay, now, these are really nice exercises, aren't they? Get you to think. That's what we want to do. And it's painful. So I have interest receivable of 7,700, and I have more interest revenue of 7,700, and I think we did everything. I think we did. Okay, what do we have for our balances, guys, on our schedule? They want a schedule of long-term receivables. So what would we have? $1 million for sales division, 140 for Splint, 400 for officers, 79,719 for PIN, right? So all those are one schedule. And then it wants to schedule for the current portion of the long-term receivable. Oh, what's the accrued interest receivable? Do this, and we'll come back and do the current portion. Okay? We haven't done that yet either, have we? Current's what you're going to pay in the next year, right?
For what they're gonna pay me next year.
Yeah, what they're going to pay us. Okay, so 60 plus 7175 plus 7700, how much is that? 74,875?
Yeah.
Let's see if we get that one. Okay, and then they want interest revenue, did they say too? Yeah, what's the interest revenue from them too, on the income statement? So it's interest revenue that would show up. 135 plus 32 plus 60 plus 7175 plus 7700. What do you get?
I got 241,875.
Okay, one more thing to do. Let's get the current, okay? And then we'll compare our numbers. You got them all written down, you guys? Because I'm gonna pull up the other sheet. So. What about current? What's current? How much is going to be paid of the? And the schedule they want is it plus interest? Prepare schedule for interest revenue. And when the long-term, the current portion of receivables. Now we just want the receivable that's current, not the interest that's going to be paid, because that hasn't been accrued yet, right? We just the accrued we're going to do it separately, right? So what do you think? How much is going to be paid on the first one?
So the first one, they're gonna pay another.
$500,000 once
Yeah.
a year, right? So in the next 12 months, what's it going to be? $500,000? So here's the current portion. The current portion. And the rest is long-term, right?
Yeah.
Okay, that's it. So on the first one, it's 500,000. You guys agree with that? I think that works.
Your officer one's still gonna be 400.
Zero.
Or no, 0 because
Nothing's going to be collected.
yeah.
Its due date isn't until December 31st. Wait a minute. It's due 2016. So zero on that one. You guys agree with that? Third one,
Third one.
they're going to pay me what?
Oh, interest bearing note due on April 1st, 2016.
So are there any payments? That one has no payments, does it? Is that zero?
The whole note's due at that time, so no, I don't think so.
Not until more than a year from now, though, right? From December 31st, 2014. It's not due until April 1st, 2016. So zero, I think, for that one, don't you? Okay, the fourth one?
Equal annual payment for principal and.
Oh, what about our note received from the sales division? Did we do that one? Yeah, we did that, didn't we?
That was the first one.
Oh, okay. And then the officer, but the second one? Oh, okay. Yeah. All right, good. And the fourth one?
We have equal annual payments of 45,125.
So what do you want to use? Do you want to use 415125? They're annual, right?
No, we don't want to use.
Why don't you want to use that?
This what? Wait,
Some of it's what?
interest.
Interest, which we don't owe yet, right? But that is going to be a payment, though. So what about the interest? How much is interest? This is the payment. How much is interest? Equals principal, right? You guys agree?
Yes.
And in fact, this 500,000 is going to have interest too, isn't it?
Yeah.
We could plus interest on this one if we want. That one's principal. And this is going to be the payment. You agree? Okay. How much is the interest going to be on the first one? It's going to be $1 million that we still owe them times 9%. Aren't we going to pay $90,000 next year?
Yes.
So our total payment is going to be $590,000.
So
right?
It wouldn't be for 2 periods, because we're only holding $1 million for,
One more year, and then the next year will be 500,000 times 9%, right?
okay,
It's just what you owe them for that year, right?
okay.
Okay. Well, what about interest on the other two? We're not making payments, are we? So no problem. There's no interest on those. Okay, there's no payment on those, so we're fine. Okay, so what would be the interest portion of this? Take the carrying value of the loan, what was it?
Wouldn't the second one have those interest payments? So I guess you would technically add it to that 0 and have a payment, or would you not?
Do they have interest payments in the second one?
Yeah,
Oh, okay, we could. So what were the interest payments? On the second one, there is an interest payment?
yeah, he has to pay interest every year.
And how much,
Interest is payable annually on December 31st.
and how much is that? I don't know, did we do that interest payment? We didn't do that either.
No, we did.
Yeah. Where was their interest payment? There, cash and interest revenue, is that it?
Yes.
32,000. What's it gonna be this year?
It's gonna be,
He's not paying any of the principal, is he? So it's still 32,000 again?
yeah,
Okay. So he'd have a payment of 32,000 then, wouldn't he? Right? So that's on this one. That's on the second one or the third one?
second.
Second. And the third one doesn't pay any interest to the end?
Yes.
All right. Okay, good. So the question is, should we be showing the payments or should we be showing the principal reduction? Okay. Well then, this is principal, and we're gonna have principal over here, and there is no principal payment on the other two, right? So what's the interest gonna be on this? How much is owed on that one? 79,719, is that right? And we accrued interest of 7,175?
Yeah.
So of this next payment, what's the payments on this thing?
Wait,
Is that the one?
no, it's the fourth one. That one right there.
Oh, this one?
Yeah.
Oh, okay. What's the payment on this one going to be? We know the payment is,
45,125.
okay, how much is interest? What would you do? 140, no receivable, because there's been no payment yet, right? Times 11% for a full year, right? With me? So if you wanted to know how much the interest is going to be for the full year, that's what it'd be, right?
Yeah.
How much is that?
15,400.
15,400. So the principal reduction is going to be the difference, is it? About $30,000. How much is that? 29.
17.
Okay, let's see what they did in the answer. Take a look. We can hang on to this too. Bring it back up later. Okay. Go to Moodle. Told you these are cool. I just give you pieces of it. I wouldn't give you the full-blown thing, right? On a quiz. On a test, I could do it though. Come on. Right, there it goes. Mouse not working. There it goes. Right. I hate this thing that we have set up. They made it more cumbersome, didn't it? Just let us in. Okay. Go. Chapter
7.
number
710.
we're waiting. What is it? There it is.
Raise the best controller.
Yeah, it would have been easier maybe to, I'll look at that later. So, look at all this. Interest revenue, 151,873, is that what we got? Really? They said 105,000 note receivable from the sale of the division. What did we get? We have 7173, we have 32. We did too get this. Did we not get the 105? Yeah, we did. And it's to our number.
We got 135.
Yes. Oh, we got 135.
Yeah.
The division is $1.5 million, right? Times what interest rate?
9%. 4.
Oh, that would be a whole year.
Yeah.
And it's not a whole year, is it? Unfortunately, 8 months. So take 8 twelfths of that. That's 105. Way to screw up. That's it, though, isn't it?
You said 8?
We said 135
Yes.
divided by 3 times 2.
I got 90,000. Because that's 45,000.
135.
Yes. Divided by 3 would be 45. And then 45
Okay,
times
what?
3.
Then it's not 8 months, it must be 9 months. Darn.
It says May 1st.
Now, let's see what they did down here. It's number 6. Interest, okay, interest earned. Oh, it's 45,000 for the first 4 months, and then it's 60,000 for the last 8 months. Boy, that was tough. $1.5 million at 9% for 4 months is 45. $1 million at 9% for 8 months is 60. We read it wrong. That makes sense. So I screwed that one up. Okay, we got the 32 though, didn't we? We got the 7,700 and we got the 60.
Oh.
You see what they did though? We read it wrong.
Well, you were supposed to read the beginning part where it's like the following long-term receivables about December 31st, 2013, $1.5 million to
and
that
it rolls
point.
forward. So you got to just relax and do these. Yeah, that's a monster. Okay, then let's see how we did on the other parts.
Yeah.
So we screwed that one up a little bit. Okay, here's the long-term receivables. We have 500,000 on the 9% note receivable. I thought we had $1 million left. Did we miss a payment? Oh, less current installment. Yeah, we'd have 500. It'd be $1 million less 500, right? It's 500 for current. 500 long-term, 500 current.
Okay.
And then the 8% is 400 all long-term. And then the zero interest bearing, we got that one right? 86873. And then the contract, 2 contracts, let's see, do an annual installments less the current installment. So it's the 45,125 twice, okay, for 100. Less the interest, yeah. So let's see. Oh, man. So here's our current portion of receivables, installment contract receivable, note receivable in the sale, and the installment. Okay, that's the accrued interest portion. And then there's the interest revenue. Here's our zero interest note. We got that right. Long-term portion of this one. Yeah, 140 times 11. There we took the interest away to get the long-term part, right? And then the sale of the division. So, yeah, we screwed up part of it. But pretty close. See you guys. Study, study, study. Those at home, don't be too confused by this. Just keep working. That's a pretty cool problem, though, isn't it? You see what happened?
Most of it, yeah. I'm seeing what you're saying. It's like bits and pieces. I'm just not.
We screwed up. I don't know. I think we said there was a. Oh no, there was $1 million less the current of 500, right? That's
Oh,
the
these are the long term.
Yeah, this is the long part.
Oh my god.
Yeah, and then this is 450 less 50, right?
Yes.
Yeah, and then this is just the amount. This, long term, and then this is this is 2 payments, 2 installments, 45,125. Yeah, and then selected balance sheet balances. Notes receivable, yeah, and then the installment contract receivable is left, yeah. That's the current part, right? Here's the current portion, those two, right? And then here's the accrued interest receivable, right? We got that, we're good. Wow. And then here's all the revenue, and we screwed up that one on the revenue. So, yeah. Pull out the answer and crank through it again. This is just going to be just work every single problem in chapter 7 and be in good shape. That's really a way to go. Over the weekend, have this thing wired.